Is it recording?
Yeah, it's recording now.
Okay, perfect. Imagine a bike that doesn't just fit you, it's made for you. At Pedal Peak, we're redefining performance with cutting-edge 3D printing with ultralight carbon fiber to create bikes built for speed, comfort, and the ride of your life. I'm Grace Lacrosse, VP of Marketing.
I'm Dylan Epstein, VP of Finance and Accounting.
I'm Josh Cagman, the president.
I'm Mia Fischelli, the VP of Manufacturing.
I'm Faisal Haj, VP of Business Analytics.
We're going to start by talking about our strategic decisions and then head to our scorecard analysis, our team dynamics and decision making, and then we're going to end with lessons learned and our next steps. First, for our strategic decisions, we're going to talk about product and pricing decisions. We started with 4 bikes, 2 recreation, and 2 mountain bikes. We thought this was best because those were the 2 areas that were highest in the first stores we opened in New York and Amsterdam. In Q2, we decided to add a speed bike to help with diversity and make sure we have everything that we need. We set all of our prices for these 3 bikes to these 5 bikes to the price that everyone was willing to pay, with a rebate of $50 to $75 to make it a little cheaper to be able to compete as a new company. In Q3, we got rid of one of the recreation bikes because it was not doing very well. We improved our top mountain bike, but our rebate stayed the same and our prices increased by 50 to 100 because we were doing well in our areas. Our speed bike was the top. In Q4, we added another recreation bike and a new speed bike. We improved our top bikes in all the categories with the new features we could add. And we increased the prices of the improved bikes, and our rebates were between 50 or 100 to still be able to compete in the market, but also have our brand stand out. For advertising decisions, those started in Q2, and we bought market research for every quarter. We started with 3 ads, one for each one, recreation, mountain, and speed. We had 3 major media placements for each one in the top areas that they told us were the best, so it would reach the people that we knew were interested in these bikes. We worked on internet and keyword placement for those 3 ads to get as much information out there as we could and be seen. On all of our ads, there was about 5 different parts. So our name, some features about it, a nice little picture, examples of some of those parts of our ads. In Q3, we had the most clicks on our online ads from Q2. So we added another mountain bike ad because it was not doing our mountain bikes weren't doing as well. So we upped our ads for those to push those into our market. We added 2 major marketing placements for that new mountain bike ad, and we added a social media campaign for those first 3 ads to continue the awareness on those ads. And finally, in Q4, we added new recreation and speed bikes. So we had 2 of each bikes. We updated all of our ads to make sure they had all the features up to date and made sure everything looked as good as possible with all the new features we could add to it. We added 2 major marketing segments for the 2 newer ads, and we started paid ads for all 6 so that it could reach a higher audience. And we paid the average budget for those paid ads because we had already spent so much money on marketing. We just wanted to make sure we were in every area possible getting our name out there.
Thanks, Grace. Now let's shift gears and dive into our Salesforce strategy. This slide gives a quick overview of all of our key decisions across all the 4 quarters, and next I'll walk you through each quarter in more detail. It was very important for Pedal Peak to make the best store and hiring decisions that we could. We wanted to have the right place and the right people to sell our bikes. Starting in Q1, we decided to prioritize mountain first, recreation second, and speed third. So in Q1, we launched Pedal Peak by opening stores in New York and Amsterdam. New York was the clear choice for mountain demand, while Amsterdam offered strong recreation potential and solid speed demand, giving us a well-rounded presence early on. This positioned us to capture a large share of our core target market and build early momentum. To support these launches, we hired 6 employees in each city and provided target training. In New York City, we focused on mountain, recreation, and service, while in Amsterdam, we emphasized recreation and speed. Next, in quarter two, we kept our priorities the same with mountain first, then recreation, then speed. But we expanded into Rio de Janeiro to tap into its strong recreation demand and solid mountain demand. By entering this market, we extended our brand presence into South America. Meanwhile, we maintained staffing levels in New York and Amsterdam, keeping 6 employees in each store. But to support our Rio store, we hired 5 employees, 2 trained in recreation, 2 in mountain, and 1 in service, bringing our total workforce to 18 employees. This approach ensured each location had the right mix of skills to meet customer demand and deliver a high-quality experience. Next, in quarter three, as you can see, we had a priority swap. We realigned our strategy to focus on speed as our top priority, followed by recreation, then mountain. With this shift, Bangalore stood out as an ideal and safe expansion choice because it offered the lowest lease and setup costs, making it a cost-effective entry into a previously untapped market. In Bangalore, we hired 5 employees as well, 3 trained in recreation, 1 in speed, and 1 in service. We also added 1 staff member in each in New York and in Amsterdam to maintain strong coverage to stay competitive and reward performance. We also upgraded our compensation package, increasing salaries to $20,500, offering full health coverage, 3 weeks vacation, and a 3% pension match. Lastly, in quarter four, we didn't open any new stores, but we strategically increased and restructured our sales and service teams across all locations to better match our updated segments, priorities, and performance insights. We added 7 new employees, raising the total to 25, and adjusted training allocations to emphasize speed and recreation, our top 2 priorities. For example, Bangalore, a newer store with high recreation demand, was staffed with 3 recreation employees, 1 speed employee, to strengthen its performance. We also increased the number of service-trained employees in each of the cities to enhance customer experience and drive retention. These changes positioned each service location to serve its unique demand and profile more effectively with the added new cost of opening a new store. As you can see, this slide includes a visual of how our sales force decisions from quarter two stacked up against the industry average. Let me explain why these decisions were the right move. Investing in expanded health benefits and more vacation time aligned with the high importance scores employees placed on these areas by slightly exceeding salary expectations and improving benefits. We created a more attractive and stable environment for our Pedal Peak team. From printer to pedal, here are our manufacturing moves and how they're going to push us ahead of the competition. Investing in 3 printers in quarter one, this sets us up to meet strong early demand, avoiding costly overtime and securing long-term flexibility. It balances costs and growth and potential and positions us ahead of competitors who may have underinvested in production capacity. In quarter two, we didn't add any new printers because our existing capacity is nearly double of our projected demand. This decision saves costs and avoids excess capacity while still leaving room to grow. However, after experiencing stockouts in quarter two, in quarter three, Pedal Peak wanted to get ahead, so we added 7 new printers to meet our projected quarter four demand. This gives us full coverage with room to grow, also avoiding costly overtime and stockouts. In quarter four, we added 4 printers to scale our total capacity, which was well above our projected demand. This supports future growth and keeps us ahead of the demand curve without overextending investments.
Thank you, Mia, for providing us with an outlook of our manufacturing decisions throughout the year. I think that's a very good segue into our finance and accounting decisions, considering, a lot of our decisions relate to our fixed and operating capacity and our labor force. So in quarter one, we took a conservative, more stable strategy to test the market by opening up sales channels in just New York and Amsterdam, designing a limited number of bikes, and purchasing 3 3D printers. To make these expenditures and get our company off the ground, my team and I provided seed capital of $1.5 million, which is what we based our business decisions on for that quarter. Looking at our balance sheet for quarter one, we want to keep a significant amount of cash or cash equivalents, including the certificate of deposit, on hand in case of emergencies. The purchase of 3D printers increased our long-term assets, and with no debt and all our seed capital, our equity was very strong for the quarter. Our net income came in negative, but as a startup company, that was expected considering we don't have any revenues. Looking at our pro forma cash flow statement, we had negative operating cash flows, negative investing cash flows, and positive financing activity, which is common for a startup in the introductory phase. In quarter two, our pro forma cash flow statement reflected the expansion into Bangladesh, labor expenses, and marketing expenses to create ads and build our image. We bought back another 500,000 worth of stock, which we used to cover these expenses. With the sale of bikes giving us a projected gross profit of $165,154, our operating profit was still negative, but only at $286,000 in the hole, leaving our earnings per share in the negatives as well. Yet, due to our purchase of market research, we expected our demand to increase and have revenues greatly improve in the next quarter, which they did. In quarter three, we saw projected revenues jump to over $3 million with a gross profit of around $2 million. Our net income was approximately $1 million, giving us positive return for our investors. Because we saw stockouts in our inventory, as Mia mentioned, we decided to purchase 7 more 3D printers, which greatly increased our net fixed assets on the balance sheet. Our investing activities on the cash flow statement were negative, while our operating and financing cash flows were positive, which reveals us as a growing and maturing company. As we grow as a company, we are increasing our labor force and expanding our sales channels, which increases our expenses. It is important for us to weigh the demand, project our future revenues, and minimize expenses to maximize profit. In doing so, we saw our gross profit double from quarter three to quarter four, leaving us with a net income of around $1.5 million and 59 earnings per share. We value our stakeholders and our team, so to see strong financial performance and better returns for our investors is very appealing. We pulled all of our money out of the CD in Q4, purchased more 3D printers to cover demand as we grew, and had very strong operating cash flows, which reflects our strong profits. We always keep cash on hand in case of emergencies or a liquidity event as well. Overall, we balanced our risk portfolio and made our decisions based on demand in certain markets, the labor force required, and marketing activities. To stay afloat, we kept cash and cash equivalents on hand, utilized market research to project cash flows for the year, and made decisions based on that, as well as tried to maximize our operating activities to be the most efficient. Thank you.
As you can see in Q2, we did not do well on the scorecard. We had a 0.8, but we did learn a lot from this quarter. One thing we noticed was that our financial performance was really bad, and the main reason for that was we didn't know how much demand there would be, and we produced a lot less bikes than we needed. However, one thing we did really well on was the investment in future section. We had a score of 10. For Q3, we did much better. We learned from our mistakes from the first 2 quarters and were able to improve our manufacturing errors. However, we learned about ill will in this quarter, and that really hurt our demand. So it could have been much better if it was not for our Q2 performance. And we also want to focus on having a good contribution margin. So even if we don't sell that many bikes, we make a good profit. Now on to Q4. We once again improved. We learned a lot about how our demand, advertisements, and customers like bikes, and much more. In Q3, we noticed that our market share dipped from Q2, and one of our goals was to be the market shareholder or leading and hold it. So we ended up having a majority of our market share for every segment of bike in each of the cities. We also noticed that we couldn't meet our demand for the last quarter, even though we produced the most that we could. So we invested in the future by buying 7 more 3D printers. And now I'm going to pass it off to Faisal to talk about team decision making.
Thank you, Josh, for the visual. Moving on to team decision making and dynamics, I could say that our team divided the responsibilities very clearly right before from the beginning. One person focused on the finance and cash management, another handled marketing strategies, and another managed operations and production. We met every week to review our performance and adjust decisions. A good example of successful teamwork was our decision to invest heavily in fixed production capacity in quarter 1, 3, and 4. That helped us scale up when revenues started growing later. However, one challenge we faced was not making enough bikes, especially in quarter 2. This had an effect on our cash flow negatively. So if we could go to the next slide. To continue on this, to fix this, we adapted by cutting essential expenses and being smart about investments in quarter 3 and quarter 4. Our strong communication and collaboration helped us recover and finish the year with a healthy cash balance of 928,000. Moving on to the next slide, uh, lessons learned. One big lesson we learned about running a business is that the cash flow is everything. Even when revenue was increasing, we faced liquidity issues became because we spent too much early without balancing cash reserves. Managing cash smartly became a top priority for us. Another important lesson was about timing our investments. Building fixed production capacity at the right moment helped us grow when demand picked up. In terms of working as a team, we learned that open communication is absolutely essential and key. We constantly shared updates and concerns openly, which helped us spot problems early and work together to fix them. Being flexible and ready to pivot quickly made a huge difference. When we had issues with the bike production and its effect on the cash flow, we didn't panic. We quickly adjusted our financial strategy. And overall, I can say that we learned that it's okay to make mistakes as long as you learn and improve continuously. The growth mindset helped our team succeed over the 4 quarters. Thank you.
Yeah, so our primary goal for the future is to keep expanding in every aspect. That means opening more stores, making more bikes, adding more people to the sales team. We want to be the market share leader, and that means we need to expand. Secondly, for manufacturing, we need more 3D printers. As mentioned earlier, we couldn't produce enough to meet our demand, even at max capacity. That also means we need to find some stability because we're in a place where next quarter we would have ill will again. So being able to find a place where we can meet demand but not have too much capacity is a place we need to find. Lastly, we want to improve our market performance even more. We have the highest market share, but we could use a little more, and we can lower our price a little bit to make that happen. We'd also want to improve our brand for some of our bikes that did not have the best judgment, and same goes for our ads, as they were good, but we can make them better. That would also improve our market share. But now I pass it off to Dylan to conclude why we should stay with the company.
Thank you, Josh. Sorry. Through our first year in business at Pedal Peaks, we've seen tremendous growth. We've explored different brands, market segments, and sales channels to establish a niche for Pedal Peaks, where find where we best thrive and not just get our foot in the door in the biking industry, but break the door down and be a market leader, which we think we have been. Our mission is to offer the best bikes geared to customer needs so that everyone can pedal on with Pedal Peaks. Thank you.